Hey everybody, Kevin with Leading Edge Financial Planning, CPA that does financial planning. Today we're going to talk about what would Warren Buffett do, or more importantly, what did he do over the last 10 years versus a um, holding just a group of companies, the good, the bad, and the ugly that are value companies. And so I just read investment analysis, portfolio management, have the opportunity to teach in February at Maryville College. Really excited about that. Went back through the evidence of why do we at Leading Edge Financial Planning use the type of funds that we use. So value, what is value? That's what Warren Buffett is. It's buying companies that are cheap or on sale. It's really an accounting metrics of the price of the stock versus the book value. Not going to get into it. All it says is, are the companies cheap? Are the companies really expensive? That would be growth stocks. So what growth stocks are companies that we think are going to grow very fast. Value companies, we don't know if they're going to grow fast. We don't know much about them. Some will go bankrupt. Some will come back stronger than we think. And there's been lots of literature out there that says value beats growth over the very long term in the U.S., foreign, and emerging markets. So anyway, Warren Buffett, in the last year, he did 21%. There were a few times the yellow was much higher than the indexes. This is the danger and the allure of investing with one person as opposed to indexes. That indexes, the DFA, dimensional fund advisors, large cap value, they make their own index basically. This is Vanguard. This is the Vanguard Large Cap Value Index. So when you do own one person or you own stocks, you are going to deviate greatly from the indexes. And that's what happened. And he finished a little bit ahead. All theory says, though, 1 year doesn't matter. It could be just random noise. It could be luck. It could be skill. 3 years, the same thing. In the 3 years, you were really glad you owned the index the last 3 years, as opposed to Warren Buffett. You see the returns are pretty extraordinarily higher. Again, we don't know if that would persist in the last 10 years. I think this is a pretty good understanding about how the index-based or passively managed, just owning baskets of many, many companies, and they're all large value companies, would do. And so the DFA fund, 9%, Vanguard 7.7. Buffett beat the Vanguard fund, but the more value-ish, the more has small companies in the DFA fund actually beat both of them. So I'm going to share one more thing with you, one more concept, but the concept here is not is Warren Buffett great or index funds great. The concept is that over long periods of time and in the future, Warren Buffett is in his 80s, what would you rather invest in? I think the type of funds that we invest in is the way to go. So let me pause it and show one more. Okay, so this is the dimensional fund small cap value. Okay, so these are companies that are not only on sale, but they don't have a lot of investment in them. Really large companies, they have tons and tons of investment in them. That's why they're called high capital weighted or high cap stocks, large cap stocks, because they have lots of money invested. These are the small cap stocks that are valued. This is the problem with investing with a style. Is that some years you'll be upset you did. So 2017, the small cap value fund from Dimensional Funds really didn't do well. And you can see this is tracking error towards the S&P and towards the large companies that we saw. It finished at 8.3%. Again, with small cap value, the anomaly only seems to happen over very long periods of time. So small value as well as large value, both were a little bit ahead of Warren Buffett in those time periods. And let me just show you really quickly the style boxes here. Let me compare this to the small value fund from DFA. Okay, small cap value. So when you look at what Warren Buffett or even the large cap value fund, it has larger companies, okay? You can see the small cap value from DFA does not. But it does have a lot of value, but they're smaller companies. And so at Leading Edge Financial Planning, what we believe in investing in is investing in all the boxes, investing in the S&P 500, investing in moderate size, investing in smaller size, and then just tilting the portfolio towards value. So I'll just finish out by saying, Warren Buffett, read the book, The Snowball, if you want to read a fantastic biography, amazing person. Going forward, we think the best way to go is to not try to invest in high-priced, actively managed, or invest in people, but invest in markets. So thanks so much for watching. Again, Kevin, a CPA that does financial planning. Thanks.